Welcome to the Deep Dive. We're here to crack open a stack of sources, pull out the key insights, and get you informed fast. Today, we're plunging into the latest results from a real heavyweight in institutional finance, State Street. Their Q2 2025 earnings just dropped. You've probably seen some headlines, maybe caught the main numbers, but there's always more underneath, isn't there?
Exactly. And that's what we're here to do. While the standard GAAP figures might show some shifts, it's really when you look underneath, especially when you strip out what they call notable items, that you see the real operational strength. So our mission today is to unpack these numbers, understand that strategic momentum, and really see how they're navigating this, well, pretty dynamic market.
Right, so let's start with those surface numbers. State Street reported Q2 EPS of $2.17. That's up just 1% year over year. And their GAAP net income was $693 million, which is actually a little down from $711 million last year. Total revenue hit $3.4 billion, up 8%. Okay, but expenses climbed 11%. So a bit of a mixed bag on first glance.
It looks that way, but it's definitely not the whole story. And this is where understanding those non-GAAP measures, the ex-notables, is just, well, critical. Because when you exclude those specific items, the results tell a much stronger story about the core business. For example, that diluted EPS, ex-notables, it was up a very solid 18% to $2.53.
18%. Okay, that is different.
Big difference. And total revenue, ex-notables, up 9% year over year. Fee revenue, which is so important for them, saw an even better jump, 12%. So making that distinction, understanding what's core versus what's maybe a one-off, is crucial here. It really highlights their operational strength.
Okay, so we absolutely need to talk about these notable items. What exactly are they this quarter? What's shifting the picture so much?
Right. The biggest one, the main driver, was a $100 million repositioning charge.
Repositioning charge.
Yeah, it was mostly tied to workforce rationalization, basically severance costs for about 900 employees. It's part of their ongoing effort to transform their operating model.
Okay, so short-term cause for longer-term efficiency gains.
Precisely. Management expects these moves to drive expense savings, primarily landing in 2026, and they're talking about a payback period of roughly 4 to 5 quarters. There were a couple other things, too. An adjustment related to an alpha client. Alpha's their big integrated platform,
Right.
where the scope changed. That hit revenue by about $24 million and expenses by $18 million. Plus a few other small bits, like a $3 million recovery from an old FX settlement. All told, it adds up to about $138 million in pre-tax notable items.
And it really does raise that question, doesn't it? How companies weigh those immediate costs against the strategic benefits down the road.
It's a constant balancing act, especially for a company this size undergoing transformation. They seem pretty clear it's an investment for future efficiency.
Okay, makes sense. So peeling back those notables reveals stronger core performance. Let's dive into where that strength is coming from.
Yeah.
The business momentum. I mean, the numbers in investment servicing are huge. A record $49 trillion in assets under custody and or administration, AUCA, up 11%. What's behind that?
Well, part of it is definitely higher market levels at the end of the quarter. Client flows help too, and some favorable currency translation. But what's really significant strategically are the new wins. They brought in $1.1 trillion in new servicing AUCA just in Q2.
Wow, $1.1 trillion in one quarter.
Yeah, mostly from asset owners and asset managers, their core institutional clients. And get this, about $380 billion of that was driven by new mandates for State Street Alpha. That platform is clearly gaining traction. They also signed 2 new alpha mandates, and 3 more clients went live on the platform in the quarter. That brings the total live count to 28 now.
So winning these big mandates, especially the alpha ones, what does that mean for revenue down the line? Is it just locked in?
It points towards future stability, absolutely. They have a backlog of $441 million in new servicing fee revenue. That's money from deals they've won but haven't started billing for yet, basically.
And that's a record backlog.
Highest on record, yes. They expect about half of that to install, meaning start generating revenue, during 2025. And the focus on these sort of back-office servicing solutions is key. It creates sticky, recurring fees and naturally leads to other opportunities, like holding client deposits or handling their FX trading. It's foundational.
Okay, let's shift over to investment management. Another record there. $5.1 trillion in assets under management, AUM, up a pretty hefty 17% year over year. They also did that rebrand recently to State Street Investment Management. What's the story there, and what fueled the strong $82 billion in net inflows this quarter?
The rebrand seems to signal maybe a deeper focus on client relationships, innovation, and trying to present a more unified One State Street front, leveraging collaboration across the firm. As for the inflows, $82 billion is strong. A record $68 billion of that came from institutional clients. They mentioned momentum in U.S. defined contribution plans, 401ks and the like, and also some product innovation helping, like adding income protection features to target date funds.
Interesting. And within investment management, the ETF business always gets attention, especially with this ongoing talk of a pricing war. How are they doing there?
Yeah, it's a tough market, but their ETF franchise actually hit a record $1.7 trillion in AUM. They've managed to gain some market share in their U.S. low-cost ETF suite, which is notable, and they saw net inflows across various areas: gold ETFs, the big SPY index tracker, funds in Europe and the Middle East, and U.S. fixed income too.
So despite fee pressure from giants like BlackRock and Vanguard.
Exactly. Despite that race to the bottom on fees, State Street's U.S. ETFs actually led the whole industry in trading volume, over $4.6 trillion traded. They were number one for equity and commodities ETF trading and top three for fixed income.
How do they manage that? Maintain profitability with fees going down?
It really comes down to a few things: diversified revenue streams beyond just the management fee, relentless focus on operational efficiency, and leveraging technology like their Alpha platform. It helps them handle massive volumes efficiently. It's a scale and efficiency game for them in ETFs.
Okay, and let's not forget the markets division. You mentioned FX earlier.
Yeah.
Record quarterly trading volumes, up 17%. What was the driver there?
Yeah, FX had a fantastic quarter. Revenue up 27% year over year, ex notables. Some of that was definitely higher market volatility, especially back in April, which tends to increase volumes and spreads.
Right, volatility helps trading desks.
It certainly can. But they stressed it wasn't just volatility, it was also the result of their efforts to, deepen client relationships, expand geographically, particularly in Europe, and sell a broader mix of products, like derivatives. It ended up being their best quarter for FX since way back in 2020. And securities finance did well too. Revenue up 17%, highest since 2019, mainly thanks to higher client lending balances.
Okay, so lots of momentum across the board. But expenses are still part of the equation. Total expenses up 11% or 6% ex notables. How are they keeping a lid on that, or are they?
Well, the ex-notables increase, that 6%, was largely driven by things you'd expect with good performance, higher performance-based bonuses, plus continued investment in tech and infrastructure, and some currency headwinds. But State Street has been pretty consistent with their productivity programs. They've saved over $1 billion in the last 3 years through these initiatives.
Over $1 billion.
Yep. And they expect that to grow to over $1.5 billion by the end of 2025. They're aiming for around $500 million in savings this year alone. Crucially, those savings aren't just dropping to the bottom line, they're being reinvested into modernizing technology and supporting that revenue growth we just talked about.
Okay, that makes sense. Let's turn to net interest income, NII. It was down 1% year over year, but actually up 2% from the previous quarter. What's causing that push and pull?
Right. The year-over-year decline, that was mainly about lower short-term interest rates compared to last year, plus some shifts in the deposit mix. They're an asset-sensitive bank, so falling rates generally put pressure on their NII.
Okay. And the sequential increase?
Sequentially, things looked a bit better. Supported by higher deposit balances outside the U.S., some repricing benefits in their securities portfolio, and loan growth helped too. They did see average deposits jump 7% in Q2 compared to Q1, partly due to some market uncertainty early in the quarter, especially April.
A flight to safety, perhaps?
Possibly. But a lot of that deposit surge went into lower spread accounts, so it didn't provide a massive boost to NII, even though the balances were up. It moderated through May and June.
Got it. Finally, let's touch on capital and returns to shareholders. What's the takeaway there? How solid do they look?
Very solid. Their key capital ratio, the standardized CET1, was 10.7%.
Yeah.
That's comfortably above regulatory minimums, giving them a strong buffer. And their liquidity coverage ratio, the LCR for State Street Bank, was 136%. That means they have ample liquid assets to cover short-term needs. Very robust.
And shareholder returns?
They returned a good chunk in Q2, $517 million total. That was $300 million in share buybacks and $217 million in dividends. Comes out to an 82% payout ratio for the quarter, and maybe the biggest signal of confidence. Following the Fed's stress test results, which were strong for them, they announced an 11% increase to their quarterly dividend starting in Q3, It'll go up to $0.84 per share.
An 11% dividend hike, that definitely sends a message.
Absolutely. It underscores their financial strength, their confidence in future earnings, and their commitment to returning capital, all while maintaining those strong capital buffers. It speaks to flexibility and resilience.
Okay, so looking ahead, they've updated their full-year guidance based on this performance. What are they expecting now for 2025?
They've raised their expectations a bit. For total fee revenue growth, ex notables, of course, they're now guiding to a 5% to 7% range for the full year. That's up from 3% to 5% previously.
Okay, decent bump.
Yeah. And on the expense side, again, ex notables, they now expect growth of 3% to 4%, which is also up slightly from 2% to 3%. Importantly, they still expect to generate positive operating leverage for the year, meaning revenues growing faster than expenses on both a fee and total basis.
Beyond the core financials, are they exploring anything particularly new or innovative? Any hints about future directions?
Well, one interesting thing they announced was a strategic partnership with the University of California. They're going to pilot a kind of super app aimed at individual stakeholders, think students, faculty, alumni.
A super app? From State Street. That sounds different.
It is different for them. It's clearly an experiment designed to test scalable ways to engage with individuals, potentially around this idea of wealth democratization. They see it as something that could potentially be leveraged elsewhere if it works. It really shows how even these massive, traditionally institutional firms are trying to adapt, trying to figure out how to play in a world with evolving client needs and new technologies.
And speaking of new tech, you mentioned tokenization earlier. Assets being represented digitally on a blockchain. What's State Street's view on that now? Is it finally becoming real?
Their take is that it's been slower than maybe people hoped a few years ago, but they see regulatory frameworks starting to take shape around the world now. That's the key. With clearer rules emerging, they expect the pace of tokenization to pick up, and they definitely view it as a major strategic opportunity.
An opportunity for them as a bank.
Less for themselves directly and more as a servicer to asset managers who want to tokenize assets. Think about illiquid things like real estate or private equity. Tokenization has the potential to make those assets much more easily tradable, cutting down on paperwork and legal hassle. If that takes off, the servicers who can handle tokenized assets will be in a key position. They see that as a big potential evolution for the whole financial landscape.
Fascinating. So wrapping up our deep dive today, we went into State Street's Q2 2025 earnings. We looked past the headline JAP numbers to see a picture of, well, pretty solid strategic execution and underlying financial strength once you account for those notable items. We saw real momentum in servicing, especially with Alpha, strength in asset management despite fee pressures, and a standout quarter in markets, particularly FX.
Yeah, it's clear they're juggling multiple things well. Continued investment in tech and efficiency drives, managing expenses, but also delivering strong capital returns back to shareholders. This dive really highlights how these huge financial institutions are constantly adapting, aren't they? Responding to the macro environment, changing client demands, technology shifts. It's a continuous process.
It really is. So as you sit back and think about everything we've discussed, here's something to maybe mull over. What do you think is the biggest long-term implication? Is it that ongoing ETF pricing war and how firms stay profitable? Or maybe this broader trend of wealth democratization, pushing institutions into new areas like that super app idea? How fundamentally might those forces change how traditional financial players operate down the road? Something to think about until our next deep dive.